What's good, YouTube family? Welcome back to the Hive, okay? Where we discuss education, stocks, everything that has to do with financial literacy, but my favorite thing to do is stocks. And today I'm going to introduce to you guys the 3 dividend stocks that I am buying in 2025, and I also have right now. I will continue to add into these, and I'll explain why, okay? So let's get right into it. Without further ado, I don't want to waste you guys' time. Let's look at Johnson & Johnson, okay? So first of all, they pay a reliable dividend of 3.45. Earnings are forecast to grow 10.63% per year, and analysts are in good agreement that the stock will rise 21.2%. So I'm going to break this down to you guys. This is how Johnson & Johnson makes their money. So first of all, revenue is determined by innovative medications, medtech, okay? And cost of sales subtracted by revenue is gross profit, okay? So this is how much it costs to, sell that, correct? So that's gross profit, and then after expenses get taken out of gross profit, these are the earnings. So this is what determines whether the company is profitable, and they are profitable, $14.77 billion, okay? So to our next chart, free cash flow is doing all right. The earnings, the revenue, the blue. All right, so the blue is the revenue, and as you can see, they are steady, and this will explain why, the stock price moves sideways a little bit, because the earnings need to grow in the future, okay? But that also means you can hold and just extract the dividends out of it, and a lot of times the share price will rise over time, okay? But they have a 16.8% profit margin, which I like for companies to be in that 10 to 20% profit margin range, and sometimes a 7.5%. So let's get right into the other part. And here is Johnson & Johnson's dividend history. So what you got to do is you have to type in J&J dividend history, or any stock dividend history. You can go to either the NASDAQ or the stock analysis. I like to go to the stock analysis. So as you can see, Johnson & Johnson's share price is $146. Now, if you look right here, they pay a dividend 4 times a year. So that means they are a quarterly paying dividend stock. And sometimes, you have monthly, you have yearly. So it's quarterly, yearly, and monthly. And as you can see, they are rising in dividend pay over time. And this is what you want to see in a dividend stock that you hold, a rise in dividends year after year. All right. And that's what we see in Johnson & Johnson. So this is why it's a very attractive buy for me. Steady, stable company that can pay me a dividend because it's free money. You get what I'm saying? So why not extract the free money, buy a nice profitable dividend stock on a dip? All right. So the second dividend stock that I want to discuss is Exxon Mobil. Just like the gas station, energy and gas. All right, pays a reliable dividend of 3.65. Analysts in good agreement that the stock will rise 20%. Earnings are forecast to grow 5% per year. All right, so a steady dividend paying stock. Now, how do they make their money? Energy products upstream. All right, other segments. So they're pretty diversified in how they make their money. All right, cost of sales cost $235 billion. Sheesh. And their gross profit. All right, so revenue, they're already making a lot. And then their gross profit is $108 billion after cost of sales is extracted, and then after expenses are extracted, they have now earned this $33.7 billion. Extremely profitable company, all right? That's worth buying on a dip. Energy, one of my favorite energy stocks to buy on a dip because it always recovers. I'm not joking, all right? Now, how does this look to us? We have their revenue. Their revenue is constantly rising so far on a trend since 2021. Revenue trend took a slight dip. All right, we're going to see if this thing can continue upward, but they're in that 10% profit margin that we like. All right, folks. So that's something that we like to see. Now let's head over to this part of the screen, and I'll show you guys that they are a quarterly paying dividend stock, and they are nearly paying $1 per share that you own. So every $108 that you spend, you get $1.99 per quarter. So soon they'll be at $1. And they are steadily rising, and that's what we like to see in our dividend paying stocks. Okay, so that's what I like. I like that every quarter I'm getting a paycheck, and I'm also making money off the share price rising. So you're getting double paid just for owning the particular share. All right, so look at this as a high powered savings account. All right, folks, that's what I like to see. These, not only am I making money off the stock, but every quarter I'm getting paid back dividends. So that's the important part that you need to know about owning a dividend stock. So right here, before we continue, I wanted to review the Johnson & Johnson chart. And right now, it's at a great buy, an attractive buy right here at this buy zone that it likes to bounce out of. And then we can go to Exxon Mobil. Same thing. Attractive buy zone that is at right here. Just recovered the 108 area. So yes, it's in that bot zone that I like to buy. So both of these are at great buys if you're watching this video. All right, Johnson & Johnson, Exxon Mobil. And then if we go to the particular balance sheets of both, all right, we go to Johnson & Johnson financials. As you can see, now they aren't doing as well as they did last year in the trailing 12 months, but that could be opportunity for recovery, because every time they drop beneath, okay, so they always so 14.7 billion, okay, possibly could recover. And then we can go look at Exxon Mobil. Still profitable though, but it's all about growth. And they are less profitable than last year by 3 billion, but they made more revenue. So I like to look at that too. Are you increasing in revenue? Because sometimes you may not profit, but you increase in revenue because you may have made, more investments, open up more gas stations, open up more oil rigs, things like that. So you got to take that into account. All right, folks. In our last dividend stock that I really like, and it's on a great attractive dip, okay, is Realty, which is a real estate investment trust, which is pretty much like a ETF type company who likes to buy a bunch of real estate, all right, and pretty much profit off of that. They pay a high reliable dividend of 5.79, which is pretty good. All right, leasing of property, that's their main income. Revenue of 5 billion, cost of sales 363 million. Okay, that's pretty good. I'm like, am I reading it? That's a pretty good. And then gross profit this, but then after expenses they only get this. So after revenue of 5 billion, they're profiting 866.6 million, nearly 0.7. All right. 17% profit margin, which I told you guys I love. But check this out, folks. Constantly rising in earnings, constantly rising in free cash flow, constantly rising in revenue. This is what you like to see. All right. And all this is the graph version of this. All right. So they're constantly rising in revenue, which I like to see. So that's definitely attractive right there. Look at that. Nearly $1 billion more every year. So whatever they're doing is definitely working. All right. So that's definitely an attractive buy. And then we go look at the charts. It's at a very attractive dip. Extremely attractive. It's at $54. All right. And the highest point was $75. So they're rising in revenue, steady on the earnings, which can improve. And yeah, I definitely believe I already own shares of all three of these that I just discussed with you guys. So that's for one. I do own shares of all three. And now you guys see why. All right. So make sure you guys tap into my chat where I do a small account challenge. We do leaps and long terms. We have a key level bot. We have everything you need. I'll pin the link in the description. All right, folks are banking, and you can bank with us. All right, I just called Johnson & Johnson. See everybody posting that, the Johnson & Johnson calls. But yes, folks, tap in so you can eat with us. All right.